Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. This video is the 7th episode in the multi-part series in which we're looking at the key lessons from the legendary investor Warren Buffett in his letters to shareholders over the last 40 years. Warren needs no introduction. He's the chairman and CEO of Berkshire Hathaway, one of the largest conglomerates with businesses covering insurance, railroads, food and beverages, and even tech. In today's video, we'll be covering how Mr. Buffett identifies the moat of a company. This means, how do we know whether a company has a sustainable long-term competitive advantage over its peers? This is part 2 on the key rules related to a moat. To view earlier videos in this series, check out the description below or head to the channel's page. Before we start, please smash that like button and make sure you subscribe to receive next videos in the series on key lessons from Berkshire shareholder letters. Now, let's dive into the 3 more rules to identify the moat of a company as per Mr. Buffett. Number 1. Return on equity. Return on equity, or ROE, is a measure of the financial performance calculated by dividing net income by shareholders' equity. ROE is considered a measure of a company's profitability and how efficient it is in generating profits. The higher the ROE, the more efficient a company's management is at generating income and growth from its equity financing. And what is equity financing? It's the money paid by the shareholders, such as you and me, for buying the shares in the company. So ROE is mainly the return on the money put in by the shareholders. ROE can vary by industry segment. For instance, tech companies have ROE in the range of 30%, while energy or capital-heavy companies may have an ROE in under 10% range. According to Mr. Buffett, if the ROE is above 15% consistently, then the company likely has a sustainable moat. Some companies with consistently high ROE are Apple at 70% over the last 5 years, Nike at more than 35%. Number 2. Capital expense. Capital expenditures, or CapEx, are funds used by a company to acquire, upgrade, and maintain assets such as property, plants, buildings, technology, or equipment. CapEx is often used to undertake new projects or investments by a company. Making capital expenditures can include repairing existing facilities, purchasing a piece of equipment, building a new factory, or developing a new technology. This type of financial outlay is made by companies to increase the scope of their operations or add some future economic benefit to the operation. This does not only apply to traditional industries such as oil and gas, railroads, utilities, but also increasing to the tech industry as well. For instance, Apple has an annual capex of around $10 to $12 billion over the last 5 years, and Google has around $25 billion. According to Mr. Buffett, if the capital expense is less than 25% of net income consistently, then the company likely has a sustainable moat. This means that the investment required to continue to grow and expand the business is just a fraction of your net income. This leaves more money for the shareholders. For instance, this ratio for Apple is around 10% and for Google is around 35%. Number 3. Debt to equity. The debt to equity, or D/E ratio, is used to evaluate a company's financial leverage and is calculated by dividing a company's total liabilities, or at least the long-term debt, by its shareholder equity. The DE ratio is an important metric and is a measure of the degree to which a company is financing its operations with debt, which is borrowed money, rather than its own resources, which is shareholder money. Again, debt-to-equity ratios vary with the industry and are best used to compare direct competitors or to measure changes in the company's reliance on debt over time. Among similar companies, a higher debt-to-equity ratio typically suggests more risk, while a particularly low one may indicate a business is not taking advantage of debt financing. According to Mr. Buffett, if the debt-to-equity ratio is under 0.8 consistently, then the company likely has a sustainable moat. This means that the company can finance its growth by using the money generated on its own rather than borrowing more money. Some companies with low debt-to-equity ratio are Meta at 0, it has almost no debt, Google at less than 0.1. It's important to remember that these are just rules of thumb. There are many nuances to each rule, and also these need to be considered in the holistic analysis of whether a company has a sustainable moat. Nevertheless, these rules are very helpful and can provide a quick method to filter companies that might have a moat. For now, that's it from us. Hope you enjoyed and learned from these rules. For other videos in this series, check out the description below, click on the playlist above, or head to the channel page. Smash that like button and subscribe to make sure that you receive the follow-up videos on key lessons from Warren Buffett's Berkshire letters. Be sure to smash that like button. Thanks for watching and subscribe for more.